we're going to get started here. For those of you just joining us this morning, my name is Elise Hobson. I'm the venture partner at HX Venture Fund, and we are just so incredibly appreciative of everyone's support today. It's amazing to see the different faces of the ecosystem coming together and not just listening to these amazing panels that we have, but really fostering the engagement and connections that we're hoping to make today. So thank you all so much for joining us. It's my pleasure to introduce the upcoming panel focusing on scaling startups in Houston and what it really takes. Unfortunately, our moderator for today, Urvish Vashi, was unable to make it due to a last-minute family emergency, but I am thrilled to introduce moderating our panel this morning will be Kyle Judah, the Executive Director of Lilly Labs. And like most of the Lilly Labs attendees, they've all been founders, operators, and VCs, and Kyle is a founder himself, focusing on supporting systems grounded in the reality of what founders really need. And as the executive director, Kyle runs the Entrepreneurship Center for Rice Campus, as he's had done for MIT and UC Boulder. Alongside, we have Martin Kay, CEO of Intera. Martin is a serial entrepreneur here in Houston, now building Intera, which is a real estate tech company that allows organizations to buy single-family homes easily across multiple markets. He's actually backed by Laney's group, Craft Ventures, by the seed and Series A rounds. And last but certainly not least at all, Laney Painter, partner at Craft Ventures, who focuses on venture investing at the seed, Series A, and Series B rounds. And every person at Craft has had some level of experience at a unicorn startup such as PayPal, Yammer, StubHub, and more. And so the members of the Craft team really have a firsthand experience to see what it takes to solve the problems of scaling. And I think we'll all really enjoy this very dynamic panel, so thank you.
Good morning, good afternoon, everyone. How y'all doing? All right, we got a little Houston energy in here. Thank you, Martin. Thank you, Laney, for being with us today. We really appreciate it. To kind of lead off the discussion here, right? Innovation's everywhere, particularly after the last couple of years, but so many founders need that special love and layer of kind of capital for scaling. So beyond more events like this, what can Houston continue to do, Martin, to kind of build on top of the infrastructure that we've laid for the last couple of years to make this a destination city and a destination ecosystem for great investors to come and find great founders like yourself?
Thank you for having me here. So basically, I think that VC funds look for really three things. Companies solving meaningful problems with large TAM, right? Large addressable markets, and experienced, bright, creative founders who are going to make it happen. And the world has really opened up, and I think anywhere that exists and you can actually communicate that that exists, they'll show up, period. So the world is not so flat anymore where there's only 2 or 3 places where folks go. There's Laney in Houston, right, from New York, but they will go anywhere that that exists. So Houston has historically really focused its technical workers in corporates, medical, these kinds of areas. It's beginning to change, but it still has the most technical workers working in corporates as opposed to technology companies. So in my opinion, there's basically 2 important things that you would need to do. One is we need to identify, support, and promote founders and businesses that really want to take the risk and go, right? So you can't just say, I want a great job at XYZ corporate and then build your life and go there. You need to actually say, it's worth me taking the risk to go, and you want the smartest, the most talented, the most thoughtful folks actually doing that. That's number 1. Number 2 is the government needs to actually focus on incentivizing great tech companies to come to Houston, because mostly where these great founders come from is actually other tech companies, right? That's where they learn the ropes, is in another tech company. So the government needs to actually incentivize, bring your headquarters, bring a hub, bring something here so that the kind of workers who actually think like that show up in Houston.
I couldn't agree more. I mean, we were just talking backstage about how Houston has all the right ingredients. And over the last couple of years, especially, they've started pointing in the right direction to build that ecosystem and give folks a reason to come from the Bay Area, from New York, from elsewhere, as they're hunting for great deals out there. So I'm curious, Lainey, you've spent time in SF, you spent time in New York now, dabbled in Miami and a couple of other spots. What can Houston continue to do to keep attracting great investors like you to come here once, twice, 3 times a year?
Yeah, absolutely. I mean, building great companies. And I think there's real advantage of Houston is building close to customers. You actually do have a huge concentration of these Fortune 500 corporates. And so if you're selling into those end markets, whether it's energy or Cisco or what have you, building and building relationships with those corporates is actually a really valuable strategy and kind of building on where you have advantages.
Right on. I know about 50, 60% of our audience today are founders, entrepreneurs in the trenches. And so I know a lot of the questions on their minds are, when is the right time to raise venture capital? What are kind of some of those crystallized high leverage milestones? So Martin, I'll come to you first. Kind of when do you think about, for a founder on their journey, the right time to start adding the right capital partners? And then Lainey, I'll come to you.
Yep.
Yeah, so I think the first question is, there's a when and there's an if, right? So if you can grow your top line revenue 2 to 3x per year, every year, for 4 years straight, you should definitely think about getting venture. If you're in a really big market, so you're not trying to solve kind of a widget problem, but you're actually trying to solve a real problem that exists in a big market, you should definitely try to actually, you should think about raising venture. If you're going to grow 25% and you're building a small solve, venture's not the right place to look. There's a lot of different places to seek capital, but it's important to know because it takes a lot of work. As someone who's done it a fair amount, it takes a lot of work to actually go down that path. You need to know if it's right for you. So if you can grow 2 to 3x for 4 years straight and then kind of keep growing, you should go look for venture. And it will really help you grow faster, get a first mover advantage, grab market share, and really build a great team. So as far as when, right? So if you hit that, then it's a matter of when. The when is when you actually have some product market fit, right? It doesn't have to be complete product market fit, but you actually can show you have product market fit, and you can actually build a case, hopefully in a financial model, that actually shows if I inject more capital, if I have better talent, if I have this, if I have that, then I can hit the metrics that someone like Lainey would understand. So you need to be able to actually communicate in a way that she and her fund actually understand how this works, right? So that's what I would say is the right timing.
Lainey, what does product market fit look like at pre-seed, at seed, when Kraft and you are investing in a company?
Yeah, so I generally think product market fit tends to come when you're getting into the $500K, $1 million of revenue. It normally means you have a number of happy customers, and there's usually like an oh crap moment that actually the infrastructure that we've built so far is not enough to support how much demand we have coming in. And so you can have kind of early flavors of this at the pre-seed or seed round, but it's when you kind of get to this scale of having customers come in the door that we can say with a little bit more confidence that we've hit this product market fit milestone.
Because venture capital is a tool, it is a means to an end. It is not the end in and of itself. But we're in a very different world of venture capital now than we were a year ago, right? And so what is that advice that you're giving to your portfolio companies now about how to navigate in these new rocky waters that kind of an entrepreneurial ecosystem hasn't seen for 12, 13 years now?
Yeah, absolutely. So, on the one hand, absolutely, the funding ecosystem has contracted a bit, and it will be much harder and much more time-consuming to raise capital in the coming years than it has been over the last couple of years. That being said, coming out of the dot-com crisis, you had the origin of PayPal, you had the origin of Salesforce coming out of 2008, 2009, you had Square, WhatsApp, Uber. There is no bad time to start a company. And honestly, the only thing that gets harder in moments like these are raising capital. It actually gets easier to recruit great talent to join your company. Your cost of acquisition likely goes down because there's less competition flooding the market. So it's really an incredible time to build a company, with the caveat that it is harder to raise capital. I'll also add that I'm not going to pretend to be a macroeconomist, and but it's a 2% contraction in GDP to qualify as a recession. We're looking for companies that are able to grow 3x year over year. And so if you have 10 customers and you can't get to 20, to blame that on the economy is probably not fair. And so we're looking for people that can grow through this and take advantage of the opportunity that it allows them.
Now, like Rice alum and Cart.com founder Omer was just saying on the previous panel, great companies are going to succeed and find a way through no matter what. But Martin, I think the big mindset shift over the last kind of year or so has been from growth at all costs to reasonable growth balanced with a path to profitability. And so, how do you think founders should be working and thinking about balancing that tension between the two so they're not getting too far out ahead of their skis, but they are still hitting the right numbers, hitting the right strategy?
So number one is you have to survive. So that's like, you have to survive, because if you don't survive, nothing else matters. So and each organization needs to determine what that means. I mean, we think about it, do I have a 24-month runway? We've raised a fair amount of capital, so we do, right? And so for me, I feel like, okay, I got 24 months. I can keep going where it is that we're going, and we're in a pretty strong place. I actually think there's 3 stages, though. People talk about profitability. Profitability is obviously important. It's one way in which you survive. There's lots of different ways in which you put capital in and reinvest. But at the early stage, essentially, you're trying to find product market fit and prove that you can actually have profitable unit economics. So it doesn't mean that you're profitable as a company necessarily, but the actual unit economics of an Uber ride needs to actually work. I'm just using that as an example. It doesn't always work there, but it needs to work. Our view on that is that gross margins need to be above 60%, ideally in the 70% gross margin, because everything else has to take that on. So if you can get 70% gross margins in your unit economics as a young company, that's pretty darn good. That's one. In mid-stage, essentially, what you're trying to do is get as much market share as possible while maintaining those unit economics, right? So how can I go from 10 customers to 20 to 50 to 100 while maintaining whatever, 70%, 60%? And it may dip a little bit, and you can experiment there, but that's the second phase. The late stage, the third stage, is can you grow and be profitable, right? And that's the third stage. So I think that, at least in our experience, you don't have to be profitable to raise capital. You just need to have growth and good unit economics. And if you're slowing down growth in unit economics for profit, like I was saying before, you're not a venture-backed company. That's not what you do. Now, could there be a period of time where you're sucking wind and you just need to slow everything down? For sure. But venture's money wants growth. The money behind Laney wants growth. That's what they're paying for, is growth. They're not paying for someone making 20% margins on a business growing 20% a year. That's not what the money behind it is looking for. So grow, have great unit economics, survive. And I think that the world will look slightly different in 18 to 24 months. It might be sooner. This is a crazy world. Things change quickly. But I think it will, if you can build that kind of business over the next 18 to 24 months, I think you'll be in really good shape.
What makes a great VC partner? Let's really dig in now, right? This is a long-term partnership, right? A lot easier to, frankly, get divorced than get investors off of your cap table once they're there. And so it's about finding the right sort of match, both philosophically, but also for the long haul of a company's life. Martin, from your perspective, what makes a great VC partnership work and happen? What's been so great for the two of you?
Yeah, one is like she's sitting there and I'm really happy she's there. So if you can actually build a great relationship with someone, because you're going to work together, so it's better to have a great working relationship than not. That's one. The second is that you want them to be pretty well capitalized, because once you build the relationship, it would be nice to be able to continue to go back and they have more money, right? So you've proven the case to someone. Like we have Goldman, and Goldman has come back every single time in a big way, you know what I mean, as has Kraft, right? In a big way. So once we know that they have $6 billion fund, it's like if we can actually hit our numbers, we can keep going back and we don't have to keep going out and looking again. The other thing is that are they connected in the startup community? So do they have a brand, right, that people know? And that really doesn't so much help in selling to our customers, but it helps in talent, it helps in legitimacy. There's a number of ways in which doesn't have to be the only brand and everyone has to know them, but within the community that you're working in, people have to know that there's some level of legitimacy, because the capital behind you actually cares about their brand, and they're not going to want their kind of portfolio companies to fail. The other question is have they ever worked in my business model? It doesn't have to be in my exact kind of company, but if I have to teach them everything about like SaaS or enterprise transaction, or it doesn't have to be like, oh, you worked in real estate, but if you've worked in something that you can actually understand what we do, so you can support and help us, that's really valuable. And the final one is, what's their network? Which is, if I need to actually go for another round, could they connect me to fill in the blank, right? Or could they connect me to my great chief of product, right? So being able to have a strategic who can help you, those are the things that we look for.
And Lainey, what is fair for founders to expect out of that relationship? Kind of what should they be coming to the table with, knowing that their VC partners like Kraft can help them with? And then, maybe where is there a bit of dissonance between founder expectations sometimes, particularly at pre-seed, and the reality?
Sure. Well, one, I'll say Martin's being very generous because he's been a very patient teacher on the single-family rental space to me and everyone else around the table. Absolutely. I think the most important distinction is that your investors are not co-founders. They're, we're advisors along the way, but the founder's in the driver's seat, and that's the right expectation to have. We can help around the margins, and we absolutely try to in terms of recruiting or closing talent, in terms of PR, in terms of legitimizing. But at the end of the day, the ball is in the founder's court to drive the vast majority of things forward. And I think that's a really important distinction to make. And I'll add that constant communication in good times and in bad, and knowing that you're having an open and honest dialogue, and that you're not going to find out 3 or 6 months later that, oh, we don't have 24 months of runway, we have 6 months. That is generally when investor and founder relationships tend to go south, is when there is a breakdown of communication or a breakdown of trust. And so I'm very lucky to have someone like Martin to work with. Those
monthly, quarterly updates, it's such good hygiene, it's such good practices for founders, because I think a lot of folks close the deal, they get the money wired into the bank account, and then the tendency might be to go heads down and build and not continue to build the relationships alongside. And so, yeah, if you all take anything away from today, it's like continue that communication channel, really build and invest there so that your venture partners can be there with you in the good times and in the bad. One of the unique aspects to Houston in particular is we have this wealth of corporate venture capital funds. Chevron Technology Ventures up here in the Ion, Shell, so many others that are out here. What's the right time on that journey to scale, Martin, from your perspective first, to think about bringing in, corporate venture and corporate partners into a financing round?
Yeah. So I think the first thing is like, why would you want a corporate partner? I mean, other than they have money. So for me, it's like, I would want a corporate partner because they could be a strong user of your product. They could help you strategically, right? So they can help you network, meet people, think through how would I actually deliver this kind of product. They can brand you as an industry leader, right? So if you're connected to a corporate, it's like, wow, they're smart. You must be smart because they're hanging out with you. And then it could be a way to exit, right? So if you get a small investment and you do really well, knowing your different ways to exit is actually really important. And without question, M&A through a corporate kind of venture is one. So that's the reasons why you would even think about corporate, right? So in my experience, and this is just my experience, I want to say it, Series B or later. And the reason being that venture is much better at figuring out product market fit. They're much more patient. They're much more supportive. You might change who you are 3 times until you get to your B round, right? And corporate goes in with a very specific expectation, and it's harder to actually make those shifts and changes from corporate. And I think that, you know, I'm a fan of corporate in the right scenario. You know, I think that the 2 biggest questions are, will being part of that corporate basically make your competitors nervous? So this is my 5th adventure, and I've had that happen where I actually had a corporate who everyone thought meant that they were all of our money, and the competitors didn't want to actually use our product because of that. So you just need to be really, really honest about that. And then you just need to also be honest about whether or not there's a expectation about pricing and service that's different because they happen to be on your cap table. If there's not, and I think that corporate venture has actually developed quite a bit, and there is actually a division between church and state, right? Where, okay, I'm your investor, and now I'm your customer. But corporate can be great, it just needs to actually be thoughtful and in the right circumstance.
So we've talked about kind of the capital strategy on the path to scaling, but one of those other constraints to scale is also finding the right talent who's been through that journey before, can kind of help guide the new company through the rocky minefield that might exist out there. Lainey, across the craft portfolio, what are some of the pieces of advice that you're giving to teams thinking about building hybrid or maybe even building remote first from the jump?
Yeah, so for better or for worse, the genie's out of the bottle on remote and hybrid, and there's not a company in the portfolio at this point that doesn't have at least some remote workers or some hybrid workers, and I don't see that going back to the way it was pre-pandemic. So I think there's just a question of how you create community, and I think we're all learning real time what this looks like. Does this look like hybrid hubs where people can come into the office 1 to 2 days a week? Does it look like offsites or retreats or working sessions every quarter together, every 6 months? What can you do to increase connectivity? The absolute upside of all of this is that if you need a chief marketing officer and there's not the right fit in Houston or in whatever city you're in for the type of business that you're building, you have the ability to go find that person wherever they are and plug them into your culture seamlessly. And the downside is really those water cooler conversations that are much harder to come by. So how can you create that water cooler either online or on a kind of regular offsite cadence in order to increase that connectivity? But at the end of the day, I think this is something that we have to take advantage of the positives of and try to mitigate the challenges with, because it's here to stay.
We see this all the time with our companies coming out of Rice, especially in the last couple of years. There have been 12, 13 companies that have come out, raised $1 million or gotten into Techstars or YC, hit $1 million in revenue. And a lot of them are choosing to have half the team in Austin, half the team in Houston, or half the team in Houston, half the team in LA or New York, depending on the market, depending on the industry. So I think there's a world of flexibility that our founders in the audience are a lot more open to. But Martin, Intera's your 5th company now, right? How much of a decision was that access to talent at scale a factor for building your kind of distributed style model with the team now?
So there's the ideal world and then there's the real world, right? And you know, in the ideal world, when we started, we knew that we would need to actually, we have about 200 people now. We knew that we would need to probably have 2 centers. It's the nature of the kind of business that we're in, which is really one where we're building, you know, engineering, product, where we're servicing our actual customers, where the majority of our customers are. We service a lot of institutional customers, a lot of which are in New York City, so it makes a ton of sense to be there. And then another center where the ops is happening, and we always chose Houston. The thing is that the world changed, and you need to actually, you know, one of the things that I would say as a founder, you need to be practical. So you need to actually live in the real world, not in the world of your dreams. You can have dreams of what you're going to build, but you actually need to have those dreams live here. So in this world, it's really hard to actually, given especially COVID, right, all of that, you need to be really, you know, we needed to add 90 people in 6 months. How are we going to do that? And not just any 90 people, 90 engineers and product people and marketing people and, you know, talent acquisition, all these different kinds of things that are really hard. So we actually chose to try to keep our 2 centers. So we have 80 people here in Houston, about 45, 50 people in New York, and then we have another 75 or so here, there, and everywhere. So, you know, and we have 25 jobs open in Houston, so go to Intera.ai. There's my plug. we are looking very, very hard for great people. So I think the answer to the question is that you need to do what you need to do in order to build your business. And in the ideal world, I would love to actually have everybody in one place for sure. There's just no way it's going to happen. So if you need to do 2 places, that's better than 50 places. But you need to go find the talent where they live, and try your best to kind of pull them in, you know, whenever it is that you can.
So I think our last question before we open the floor up to the questions that our audience and online have been submitting on over here. You know, we heard in the last panel from Caitlin this idea of founder market mission fit, right? And then product market fit from Lainey. But once you've kind of passed that penny gap and had people show a willingness to pay, once you've raised some outside capital, now you're ready to scale. What do y'all think are some of the advantages or disadvantages to scaling in a city like Houston in particular? Lainey, we'll start with you and then come to Martin.
Yeah, absolutely. I mean, to the extent that you're, you know, in your customer's backyard, or you have a tremendous network of talent to pull on here, which I hope you all do, this is an incredible place to scale. You know, where the shortcomings come in is ideally as you get into a hyper-growth mode where Martin is today, you want to find that person who's actually done this before to lead a functional area. And so, you know, maybe they didn't lead as the chief product officer, but they were number 2 in command in a similar startup and has experienced that kind of rocket ship growth and what sort of infrastructure and team building they need to put together. And so looking for those people that have done it before, there's probably fewer of them in Houston because you've had fewer IPO exits than, say, a San Francisco has. And so then it just becomes a question of, can you recruit them here? Or can you have a hybrid or 2 HQs in order to accommodate, you know, the type of talent that you need to scale in leadership positions as the company grows?
Martin, what about you? You've been here for 17, 18 years. You've seen Houston change phenomenally in that time, particularly the last couple of years. What do you think are, I mean, you're literally scaling in Houston, so what are the advantages and disadvantages for your company?
I'm bad news first, and then I'll do the good news. So what's difficult here, there's tons of talents, but they're risk averse.
Yeah.
Period. So Rice, MBA, 12-15% will go into tech. Harvard, 20%, Stanford, 40% from the MBA program. Why? And the reason is that there's more, the attitude is it's better to get a good, safe job that pays me X hundreds of thousands of dollars and I'm on my career track and I go. But you lost your opportunity to actually really build something meaningful and big. And that's the opportunity. So you need to get more talented, smart, committed people to take the risk and to actually say, I'm going to go do it. So, and we don't have that. I mean, we have some, but we need more, significantly more of the bright ones and the smart ones and the talented ones who could go get that job somewhere else, but they say, no, I don't want to do that. I want to actually do this, and I'm going to try to go for it. So that's what's hard here, is you don't have as many. What is great here, and I wrote a whole bunch down, business friendly, great place to travel. You know, I here, there, and everywhere, and it's the easiest city anywhere to travel in. Great educational institutions, huge talent pool, super high quality of life, lots of capital. There's more capital here and around. They just need to actually be trained on how to talk to people like you, right, about this. Everything is reasonably priced. Lots of corporates to do lots of great stuff. You just need to take advantage of all of that and actually have your brightest, most talented, most aggressive people wanting to actually build something in this place.
Yeah, it's a little crass, but the example that I give is you haven't seen your friends get really rich off their equity. And that means you don't value equity in the same way. When you're given those options, it doesn't mean as much to you. And so it becomes kind of this vicious cycle until you see those first couple of exits, and then people get this itch. I have this opportunity to build something much bigger and create a really durable equity value as opposed to working for a salary. And that just is the momentum just needs to get rolling in order to have that kind of attitude shift.
Now that flywheel is starting to spin, and as we see more exits, like Volumetric got bought by 3D Systems earlier this year, that's going to create a whole new crop of angels and risk capital. It's going to create a whole new crop of operators kind of spawning out, like PayPal and Salesforce and so many others have done. And that's what's going to help us build kind of the next wave of companies, of pillar companies, right here in Houston that can lead us into the future. Because what got us here isn't always necessarily going to help take us to the next destination that we want to be going. But we can build it here. We should build it here. Just depends on pulling the right elements and the right ingredients together. Y'all are here, right? Make those connections, create that surface area for being with one another. All right, I'm getting the signal that it's time to shift to our audience questions here. Lainey, we've got a great question here from Keith. Does the ease and scalability of digital products sometimes compensate for a lack of marketing strength in the early era of a fresh, brand new kind of pre-seed stage startup?
So is the question kind of skill set of product versus of marketing?
Yeah.
Yeah, it's pretty rare to find people that have experience with marketing, with product, with operations, with finance, and having the full picture in a single person or even a founding team. So, generally, building that executive team early or building kind of that initial crew of people with really complementary skills is the most important thing. And so, to the extent that you are lacking in one of those areas, finding someone that you can trust and will work alongside you that is, spikes in that area is the best way you can compensate for it.
And I'll follow up with you on a second one here, but from Rika and Tiffany, what is the commonality that you've recognized with the unicorn startups that you've worked for, worked with, and kind of seeing coming out of the craft portfolio like Intera?
Yeah, absolutely. Well, one, it's founders that have a absolutely ferocious will to win and are able to kind of build one step at a time and level up as they go. Not everyone is on their fifth startup like Martin and has had this many reps, but you can wrap it up and level up as you continue to grow. And then also, actually related to the last question, finding people who spike in areas that you don't to help support you along the way is absolutely critical, and not being afraid to fully delegate to them. One of the things that gives me the most heartburn in startups is when I see a CEO has 11 direct reports. That is not scalable. We're trying to build businesses where the business could run, even if Martin steps out for a week or a month or a year eventually, and kind of continues to go on. And so in order to build an enduring organization, it's all about building a team and a structure that can support that.
Houston has this phenomenal legacy and connection to the military, the armed forces. We have so many veterans coming out of a place like Rice and just in our community who can be a phenomenal, determined, gritty entrepreneur, gritty operational person to come into scaling companies. How should those veterans, how can companies better connect with these, kind of underutilized, under-resourced populations that have the right mentality, that have the right skill sets, but maybe haven't had this door open to them as often or as much as they've had for some of the traditional paths?
I think what you have to do is translate your skills into something I can understand. So like we were actually looking for someone in a part of our organization, and we basically, we were recruiting people who were in the military for logistics and people at Amazon, because that's also logistics. We happened to take the guy from Amazon just because, but I would have happily have taken someone from logistics. And the reason is that they actually translated the actual skills that they learned there at scale. Because the amazing thing about the military is the level of scale and the level of how many times you iterate to actually try to make it work. And you're an organization that's designed to make it work, and it's mission critical that it makes it work, right? So it's an incredible organization. You just need to translate to me how it is that you did that over there so that I can actually understand, right, how that worked. That's one. I think the other one is that not always doing what it is that you ask. I know this sounds funny, which is there's this balance between having someone who actually you ask to do something, they get it done, and also someone who says, hey, there's another way that we might be able to get it done. Your way may not be the best. I love it. So actually being willing to both be obedient and creative simultaneously, I think it's something in my experience in having actually employed a number of people who are in the military, that you need to learn that balance, when you come into the civilian world pretty well. And it's a hard one to actually learn, but it's something that's really important for companies like ours, because we don't always do it right. We oftentimes make mistakes, and we want our folks to tell us, okay, how can we do it better?
Know where the lines are and know when to color outside the lines a little bit.
Correct.
We've got a question here from one of our Rice alum companies, Kunal Shah and Riddio Medical, who asks, we have so many of these kind of capital-intensive or highly regulated healthcare or therapeutics or med device style companies, even industrial companies now here in Houston. So for those early stage companies, Lainey, with these longer kind of time horizons to get first revenue, what are maybe some of the metrics that matter to early stage VCs along that way? I know that's a little bit asynchronous with some of Kraft's thesis, but.
Yeah, absolutely. I mean, I think the first question I'd have is echoing what Martin covered earlier, which is this a venture scale business? Are you able to grow and scale fast enough with the constraints of the physical world, which makes things a lot harder than copying, pasting with software? And is the ultimate end market over $1 billion? Can you exit within 10 years? Because that's really overall the time frame that we're looking for in terms of a very large exit. So assuming the answer is yes to those questions, I think it really also depends on exactly the regulatory environment. So, I actually purposefully avoid like FDA approval and that sort of thing because it's not my area of expertise, but there are certainly investors out there that have that area of expertise and can help guide you through different milestones to reach those goals. But just getting to a proof of concept, getting to various milestones that you can put out there. I would be really careful about when I raised capital and try to get as far as possible without raising capital to avoid selling too much of the company for a low price.
I love it. Love it. What do you all think are kind of the nascent but burgeoning industries of Houston that can kind of continue to grow into the next generation of centers of excellence for Houston? Obviously, we're a real estate city. Some real estate startups are phenomenal and thriving here. What else can be kind of a path to future growth for Houston as we try and scale our ecosystem as well as the companies here?
So companies are just collectives of people, right? So it's the question is what kind of people can you attract that actually know how to solve interesting problems in that space, that are big enough, that are interesting. If you want to be venture-backed, you need to be big enough that it's interesting. So I think it's really just a reflection of what sorts of people do we have here what kinds of problems are they thinking about, and are they willing to actually take the risk to go build something together, right? So I'm going to state the obvious here, right? So anything in petrochemical, and it could be anything in energy as a whole, which is so huge that it would feel like we would have so many different unique ways of doing things, and you pull people from big companies. So anything in energy, I think, is super interesting. Obviously, the medical industry here is very, very large. There's a ton of logistics, and there's just a lot of stuff moving through here. You know, second to LA, I don't know if we beat LA yet, but you know, second to LA, I'm going to say there's just a massive amount of stuff that actually moves through the Houston Ship Channel. So actually moving stuff through the world is a really hard problem that has a lot of value, and boy, is it big. You know, that's an area, certainly real estate, right? Things that actually deal with real estate. This is one of the largest cities for real estate. And then the other thing is anything that large corporations need, right? So there's a whole world of compliance and all the annoying things about people. You know, there's just a lot of things to being really big about being corporate. So there's a whole bunch of different problems that you can solve for them when you have them in your backyard. So those are the areas that I think would be interesting.
So that's our insider's view. Lainey, as somebody fresh to the Houston ecosystem here, where do you think or see that there's opportunity for Houston to continue to grow and continue to scale?
Yeah, absolutely. I think Martin hit the nail on the head with opportunities from the government to support more innovation and foster it through tax incentives or other programs. And I just think there's a massive opportunity to serve what our local business is. You know, in addition to all these large companies, we have car washes and dry cleaners and certainly medical establishments. You know, software is eating the world, and that's been true for 10 years, but we're nowhere close to being done modernizing, you know, the American business. And so, you know, any of these things are amazing end markets to tackle, and I think you have a huge advantage in doing so. I
think this theme of kind of the reignition of American dynamism can really find its home here, from port, logistics, shipping, obviously the military, defense, you name it. But yeah, absolutely, right? Healthcare, energy, the areas that are the grandest challenges for society and civilization, that's kind of what Houston tends to do best. Yeah. We can keep doubling down on doing that more. I know we are over time. Thank you all. Thank you, Lainey Painter, Craft Ventures, Martin Kay, and Tara. Thank you all for joining us.
Thanks real quick. Thanks for such a fantastic panel. I mean, Lainey coming in from New York to get to know Houston, to get to know you guys here while she's here. It's such a pleasure to have you. Craft Ventures is a phenomenal venture fund. We are very excited and honored to be limited partners in their latest fund at Craft. You guys probably already know this, but if you want to know more about Craft, go to the All In podcast. It's a really fun and interesting way to learn more about what Craft is doing, what David Sachs and his whole team is doing, and indeed where the venture industry is going. So with Martin, one thing I want to say is I think the smartest people can take very complicated problems and make them clear. And it's a real talent. And one of the many reasons I love your comments today, Martin, is because there's not many things more complicated than building a company. And all your remarks really put it down in a way that was clear and gave decision tree kinds of elements of thinking. So thank you so much for bringing that. And for also just bringing your expertise. Keep staying in Houston and building the company here, yet understanding our strengths and weaknesses and working with that. Finally, with Kyle, you guys all probably know Kyle already, but what a passionate ecosystem builder he is. He brings his expertise from MIT and others right here to the Houston stage, and he is a gem for Rice, and for all of us here. So thanks, everybody.